Hey everybody who watches my channel knows that I am a fan of ETF investing, especially right now in 2024. I think there are some great opportunities. One that I get asked about a lot is the ProShares Ultra QQQ ETF. The ticker symbol on that is TQQQ, and it's a lot of Qs. Basically, the reason that people aren't interested in this is it's been an ETF since early 2010. Since that time, it has had fantastic performance for investors. It would have turned a $10,000 investment in 2010, which, 14 years ago, into more than $1.8 million today. So it's we'll look at what this fund is and what it does in just a minute. Before we dive in, take a look at the link you see on your screen, fool.com/Frankel. It's a message from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now. It's the best way to support this work I'm doing on YouTube. Please take a look. The link again is fool.com/Frankel. So again, the TQQQ ETF is the ProShares Ultra QQQ ETF. And pretty much this is a NASDAQ 100 ETF that uses leverage to magnify returns. Specifically, this fund aims to deliver 3 times the daily performance of the NASDAQ 100 index. For example, if the NASDAQ 100 goes up by 2% in a day, this fund should go up by 6%. If the NASDAQ 100 falls by 1%, this fund should fall by 3%. So on a daily basis, it should be triple net of investment fees, which we'll get to in a second, of the NASDAQ 100. So I mentioned that the historical performance is fantastic. So I'll put that on the screen so you can see what I'm talking about here. So here's a chart of the long-term performance of this ETF. You can see a total return since 2010 of more than 18,000% for long-term investors. So it might seem like a good time to invest in this, especially because it's a NASDAQ 100 linked ETF. A lot of the NASDAQ 100 is the big cap tech stocks like NVIDIA, like Amazon, like Alphabet, a lot of AI focused companies. So if you're a believer in AI, you might have this fund on your radar, but it's important to know what you're getting into. This is a leveraged ETF, and there's a big asterisk I would put on that performance that you're seeing on the screen, specifically that this fund started in 2010. It's a case of very good timing. Since 2010, other than a small period in 2022, which you can see in the chart right there, it has been an excellent time to invest in technology stocks. If this ETF had started in, say, 2007, before the financial crisis hit, or before the dot-com bust in the early 2000s, we would be having a very different conversation about performance. The fund might have gotten wiped out in the dot-com crash, actually. But it's been an excellent time to invest in tech for the bulk of the 14 years or so this ETF has been in existence. And in great markets for tech, this fund is going to do very, very well. I mentioned if the NASDAQ goes up by 2% tomorrow, this should go up by 6%. If you extrapolate that over a long period of time of gains mostly, you're going to do very, very well. But it's important to note that there are some big risk factors here. So this kind of leverage can be your best friend in tough times. It is your worst enemy in rough market environments. In that chart, you saw the big dip in 2022. This ETF lost over 60% of its value in a 6-month period in 2022 when the bear market hit. But that doesn't even really tell the full story. Let me just kind of put something else on the screen right here. These are a few just kind of leveraged ETF, call them warning slides, if you will. Let me go ahead and share them real quick. So let's look at a hypothetical example. I know this exact thing is very unlikely to happen, and it's a very simplified example. Even in market crashes, you don't have, 5 days in a row of the exact same performance. But let's just, for sake of keeping mathematics relatively simple, let's just say that the NASDAQ 100 index crashes. There's an AI crash, which I don't think is going to happen, but let's just say that it does. and that the index loses 5% of its value every day for 5 days in a row. Again, extreme example, but it does illustrate the mathematics of a leveraged ETF. So, for example, on the first day, the NASDAQ 100 index would have fallen by 5%. Now, that stings. I've been invested when my portfolio falls by 5% in a day. It's not fun. But this ETF would have fallen by 15% that day. That's a large 1 day drop. A 5% drawdown in the NASDAQ in a day is not unheard of in times of market turbulence. So you would have a very, very big swing there, but it's really what happens after. So if we're looking at this chart, let's say we put $1,000 into just a regular NASDAQ 100 ETF and the ProShares version when this type of market crash happened. So after day one, NASDAQ falls by 5%. The fund is worth, your investment's worth 950. The ProShares falls by 15%, you're worth 850. So each day you're going to lose another 5% for a 5 day period. We'll say that's a big market crash. It lasts for 5 days. It's sustained, subtracting 5% of the value each day. With the NASDAQ 100, you get an ending value of about $774, a little bit less than that. Again, that stings, but if you've been invested in a bear market or market crash, that's a reasonable drawdown to expect in a stock portfolio over short periods of time. With the ProShares, the leveraged ETF, subtract 15% every day for 5 days, and you get a value of less than $444. That is more than a 50% drawdown in a market crash. That would be unacceptable to me. That's an unacceptable level of volatility. So for that reason, I would kind of make it a small position in my portfolio, if anything. But here's the key takeaways. So after 5 days of 5% market declines, we said the NASDAQ 100 investment will be worth $773.78. From that, doing a little bit reverse mathematics, it would need a 29% gain to get back to even. If you want to check my math on that, multiply it by 1.29, and you should get the original $1,000 investment back. On the other hand, the ProShares Ultra QQQ would be worth $443.71, and it would need to gain 125% from there just to get back to even. So it's been a very fortunate 14-year period for this ETF. The mathematics of leveraged ETFs do not favor investors over the long term. What this mathematics shows, the key takeaway here, the difference between these two percentages, it's a triple leveraged ETF. This 125% needed to break even is more than 3 times what you would need to break even on just a NASDAQ 100 ETF. The spread between the percentages you need to gain to make up a loss increase a lot when you're talking about leveraged ETFs. That's a big danger to be aware of. And in a bear market or a market crash, if we hit a tech stock crash, there is kind of you can make a good argument there's an AI bubble going on right now, so it's not out of the question. This could become very volatile. Now, if you're invested in this, don't get me wrong, I hope you have years and years of these kind of gains ahead of you. But it's just very important when you go into an investment like this to understand what will happen if it doesn't work out in your favor. So that's why I say if you invest in a leveraged ETF like this, at the very least, limit your position sizes, keep a watch on what's happening. If you start to feel like the market may turn, the AI bubble may burst, whatever you want to call it, there's no harm in getting out of a fund like this, but just know what you're getting into before you buy. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.